if Trump actually enacts the stuff that he's talking about, he's able to get stuff through Congress that he wants to do, talking about more tax cuts, which probably he will, because I mean, Republicans love tax cuts and they control both sides of the Congress. So that'll probably go through. Tariffs. Apparently he can do tariffs pretty much unilaterally.
Yeah.
And then, immigration, all of these things are inflationary. So if you think that like there's going to be some kind of rate relief, and we could still wind up in a situation where the markets are acting the way they are. Yeah, maybe the Fed will cut rates. Maybe Trump can like browbeat the Fed into cutting rates, but the markets are not going to go along. The markets will just be like, oh, great, free money for us. We're going to our borrowing costs are cheaper, but we're going to charge more.
Well, look at that. The Fed cuts rates and mortgage rates scream higher. Now, you and I typically talk about residential financing. We talk 30-year fixed, things like that. But today we're going to talk to somebody who plays in the commercial space. We've been watching the commercial space on this channel for quite a while. We are actively looking to scoop up some deals that we had thought might not come around till late 25 or 26. Based on what I'm hearing from Franklin Templeton, T. Rowe Price, they're talking about the 10-year note going to 5 or perhaps 6% in 2025. And where I sit, if T. Rowe Price is right and the 10-year is at 6, that means cap rates got to go higher, values got to fall. And given the setup, I think that could be the spark that causes disaster in the commercial real estate market. So we're going to talk to Jonathan Twomley. He's going to poke some holes in this scenario. Let me know if I'm right, wrong, or just all wet. How you doing, Jonathan?
I'm great, Michael. Good to see you. How are you?
I'm doing well. Yes, I was shocked by this. T. Rowe Price actually on Bloomberg said that they could see the 10-year note at 6%. And if you have the risk-free rate of return at 6%, I'm no genius, but I'm guessing cap rates got to go up.
Yeah, I mean, look, if you can just stick your money in a treasury or in a bank and be getting 5 or 6%, right, you are going to be thinking hard about whether or not to invest in other things with more risk. And it's just really simple math. I mean, a lot of people have just either forgotten this because it was so long the last cycle, or they never knew it in the first place because they got involved, started out their career in the last cycle. But you're always fighting against the risk-free rate of return. And the riskier your deal is, the higher return investors are going to demand for it. So cap rates are going to rise. And I'll give you another piece of information that sort of dovetails with this. We're still seeing rents softening.
Yeah. NOI is not getting better.
Yeah. In many parts of the country. Yeah. Right. And now your gateway market, it's just kind of funny how we're seeing like this is like return to 2005 or something, right? I mean, it's like suddenly, when I got involved in multifamily in the beginning, and I was here in New York trying to raise capital, and people looked at me like I had two heads when I told them I was going to be investing in like South Carolina, right? And because they said, look, anybody can build whatever they want in places like that. You have no protection against oversupply, right? And so why would you do something like that? And I was like, well, look at this demographic growth. This is gonna cushion us. But what we're seeing right now is a flight to safety back to these markets where it's very tough to build, and they are seeing rent growth. New York City has 5% year-on-year rent growth. Guess what it is in Austin?
Oh, I'm going to go negative 5% or worse.
Exactly. Negative 5.6% rent growth. While expenses continue to climb 4%, right? So that is whacking NOI. And if you then add, so basically what that's telling everyone is, hey, multifamily is risky after all, right? It is not risk-free, even though it was portrayed as risk-free for so many years. It is not risk-free. And therefore, I need a better deal from you, Mr. Sponsor, if I'm going to take my money out of the bank where it's getting 5%, or I can invest it in treasuries at 5% or 6% and invest in your deal. We're going to go back to the era when you're going to have to give people like a really credible 20 IRR, right? When I started,
break that down. So 20 IRR is like for the complete ownership period.
Yeah, right. So so what that means, I mean, just really, really simply, 20 IRR is you're talking about doubling your money in 5 years, probably a little better than 5 years, doubling your money, right? So for years, we've been down in kind of like 15% IRRs because the cost of capital was so cheap, right? But now if you're talking about 20 IRR that your investors are demanding from you, like it is virtually impossible to do that in this environment unless you're buying at like an 8 or a 9 cap, right? So
yeah, that's exactly. And again, I'm just trying to play devil's advocate here, right? If they're right and the 10-year goes to 6%, or even sniff is 10 or 6%, 5.7, 5.8, cap rates got to go up. And again, I'm talking Class B and Class C. The people that watch this channel aren't, Blackstone, they're not buying tippity top Class A stuff, right? We're buying value add Class B and Class C. And that stuff's got to go up. I mean, it's got to go to 8 or 9. And the reason I think pain is coming is because, again, as we've talked about, I think there's something like $1.5 trillion in mortgages that got to be refinanced. And what I have seen over the last 6 months is banks were getting comfortable extending and pretending because they thought rates were going lower, right? Rates went lower enough. Every point that went down, the deal gets easier to finance. Now, if rates rip the other way and we go up 150 basis points and NOI keeps falling, at some point, banks are going to go like this. Get rid of it.
Yeah, I mean, that makes sense unless what the banks are concerned about is that if they foreclose, they're not going to get their full capital back, right? Because if cap rates go up enough, then
let's be clear. If this happens, they won't get their capital back. Well, not all of it. Yeah.
So I could see a situation in which banks want to continue to extend and pretend on the theory, but they're not going to be able to do it for like, okay, we'll extend by a year. I mean, they're going to have to like look at some serious long-term extensions.
Oh, it'll have to be a decade, at least 5 years.
I was going to say 5 years, right?
Yeah, at least
because they've got to get the deals have to have the opportunity to grow NOI enough to make up for the rising cap rates. And let's be really clear. Like, I do not think that interest rates, absent some kind of calamity like COVID or like the financial crisis, interest rates are not going back down to zero anytime soon, right? Talk about the Fed funds rate, right? So we're just in it drives me nuts that people are still talking about higher for longer. We're just back in a normal interest rate environment. Right?
It's just longer.
It's not longer. Like longer implies it's going to go down, but it's just going to take more time. It ain't coming down. Like rates are not coming down to where they were before. End of story. They will not go where they were before. Even 2019, they are not going to get as low as they were in 2019 either. Right.
Yeah.
End of story. So if you're sitting around thinking that, well, higher for longer just means eventually we'll get down to rates of 2019. We've had like a secular change in the economic environment. We're not going back. And if Trump actually enacts the stuff that he's talking about, he's able to get stuff through Congress that he wants to do, talking about more tax cuts, which probably he will, because I mean, Republicans love tax cuts and they control both sides of the Congress. So that'll probably go through. Tariffs, apparently he can do tariffs pretty much unilaterally.
Yeah.
And then immigration, all of these things are inflationary. So if you think that like there's going to be some kind of rate relief, and we could still wind up in a situation where the markets are acting the way they are. Yeah, maybe the Fed will cut rates. Maybe Trump can like browbeat the Fed into cutting rates, but the markets are not going to go along. The markets will just be like, oh, great, free money for us. We're going to our borrowing costs are cheaper, but we're going to charge more.
Exactly.
Right? So
our margins just went up.
Yeah, the banks will love it. The banks will be thrilled, right? But it's going to. I just don't see us
Well,
returning capital.
that's the key for me, because when I look at this, and again, I just can't fathom a 10-year at 6%. That was T. Rowe Price, but I could see a 10-year at 5%. That was Franklin Templeton's call, ING Bank. Because shoot, we're almost there, right? I think today we're up to 4.6 and change. I think that, to your point, I think eventually banks are going to understand, because I think right now bank presidents are still saying or thinking higher for longer, meaning that at some point in the future, rates will come down and their balance sheet will look better. The loans will look better. I think the first bank president to realize that it's just, we're here, that's when they start looking at their balance sheet going, all right, I guess we got to lick our wounds from the stupid deals we did with 3-year bridge debt. And that's when the losses come in. And it's the first, and again, what last time I learned in the GFC is the first mover wins.
Has the advantage, right?
At the first bank that recognizes, if they sell they're going to take the smallest losses, and then everybody else follows. And that's where losses get wild.
Right. Well, that's when you have the cascade of lower values, right? So I guess it really just depends on the discipline of the banking sector as a whole, or that banks being able to hold out against it. I think the calculation for them is going to be, though, that if they want to recover their full principal on these loans, they're going to have to just wait out the grind.
Can they do that, though? I mean, could they? Because not only do they have to wait at least 5 years, maybe longer, but they probably also have to give rate relief. You can't just take this asset that was financed at 3%, say, hey, okay, we're going to charge you 8% now, and hope it works out. I mean, they're not going to be able to pay the bills.
Yeah, I mean, they are going to have to be reasonable on rates, but so they'll extend under the current terms, right?
Oh,
so
you really? Oh, I cannot imagine a bank would do that, but maybe.
Well, I just think it really depends. I don't know how they're making these calculations, but I think maybe some banks, if they have a relatively small amount of these loans that are coming due, that it's not going to impair their balance sheets. But I mean, if they're like looking at, like having to write down billions and billions of loans, it could push them into insolvency theoretically for some of them, right?
So I think many of them are insolvent. If they were honest on mark to market, they're insolvent today.
Right. So they don't want to realize those losses. And so I think that, so the one hope sort of on the horizon, I think, for banks that are heavily involved in multifamily, and let's put office aside, that's a whole different mess.
Yeah.
But for banks that are heavily involved in multifamily, the supply overhang is going to dry up.
Oh yeah.
By like 2026. Right. And really, at these interest rates, it's going to be some time before a lot of stuff starts getting built.
That's true.
So I do think that if they're looking at that, they can say, okay, we are going to start getting some better NOI growth starting in 2026. And so if it's 2025, if we're kicking out a loan to 2028 or 2030,
I think that's all wishful thinking. I don't think bank presidents are sitting on the books or looking at, they're going, oh gosh, can I take these loan products, push them out to 2028 because we think things will get better?
Well, I just don't know what the alternative. It's sort of like a certain loss versus the prospect of getting out with your ass intact, essentially, right?
Well, so I think isn't it called Prisoner's Dilemma?
No, that's where two people are like, you don't know what the other guy is saying.
Well, that's what I'm saying is again, as I said earlier, I think the first bank to do this wins. So if you take 8 bank presidents, sitting around the table, the first one that decides to do it gets all the gravy, gets out of jail free, and the other 7 suffer. Right. So that's again, I think Prisoner's Dilemma is 2 people, but I just think there's 8, just theoretically 8 CEOs looking at their balance sheet, looking at losses, going, hey, if I pull the trigger first, I take the least haircut. I don't know. That's kind of how I look at that.
Yeah. I mean, I don't think that that's implausible. I just think that there's another also plausible alternative to that.
Yeah.
Right? So
that's fair.
Yeah, because it's really hard to determine, like, to predict what, how these banks are going to act. And I think it depends on a lot of factors that we just don't know, like what percentage of their balance sheets are comprised by these loans. Like, are they performing now? Are they not performing? I mean, if they're not performing, I could see them moving on those loans. Because
Yeah.
Why,
Why wait?
why
Yeah.
wait? Right? They're not gonna come back. But I think if the loans are performing, if they think the sponsors are solid, if they're looking at the sponsors and saying, hey, look, these guys are doing their job, they're doing what they need to be doing. But it's just the market moved against them.
Mhm.
I think that they may keep some of those loans and just say, look, we're just going to,
Yeah. They're gonna
just kick this down the road and hopefully get out. But I think for a lot of sponsors who were, already in default, right? I think those things are probably the chopping block candidates, right?
Something else I wanted to ask you about. I heard from a couple of LPs and GPs kind of on the QT the last couple of weeks, and I started to hear, frankly, something that pissed me off. They're basically saying that, hey, Trump's a real estate guy. He's a commercial real estate guy. He's going to come in and he's going to save us. He's going to come in and he's going to, browbeat the Fed and the Treasury and blah, blah, blah. There's going to be some massive bailout for all these bad deals. And I'm like, no, we don't need bailouts for people who did stupid things. Right.
I just think that's really grasping at straws, right? That's kind of the like, oh yeah, I need help really badly. Oh, Trump is a real estate guy. Oh, he's going to want to help me. Right. I don't.
I don't either. I mean, again, if you look at Trump's history, he obviously knows that bankruptcy is a tool. He's used it several times, I think. So I don't think Trump's the kind of guy that's going to go, hey, let me bail out the stupid idiots who paid too much. He's going to be like, dude, you guys did a bad deal. Eat it.
Yeah. I mean, plus here's the thing too, like now the way that these loans work, they may be non-recourse, but they're not fully non-recourse,
Yes.
which means that you're signing these guarantees that kick into effect if certain things happen. One of the things that will cause them to become personal guarantees is if you declare bankruptcy.
Ooh,
right? So you can't declare bankruptcy to get out of these loans. I mean, you can, your entity can, but then the bank is going to come after you personally. And I think we just actually saw this. I think this was in the Real Deal regarding the Tides guys.
Yes,
the Tides equities. That. The banks are now going after them personally.
Yeah, for like the tune of $25 million.
Yeah, it's not, not insignificant. And so this is the kind of thing that could happen. Like, so you can't get out of them by declaring bankruptcy. Mm-hmm. Your best option may be to just, hand the keys back and take your lumps. And, that's really bad for sponsors because they're basically talking about, you get foreclosed. I mean, you're pretty much out of business for a while at least. So banks are not going to be lending you money again for some time. So just gonna say you're between a rock and a hard place if you overpaid for deals.
Hey, bad deals happen all the time. Learn your lesson and move on. So let's kind of summarize this in the last 10 minutes, just for the average person watching this. So is it fair to say that the higher the 10-year note goes, the higher cap rates go and lower values are? Is that just a simple thread?
Yeah, like all things being equal, if if interest rates go up, cap rates really have to follow. There's just and the basic reason is math. You've got to.
It's just math.
Yeah, you have to cover your debt service by some multiple, right? Which is usually 1.25, and just by virtue of that will just put, as interest rates go up, that number just goes up, right? Your debt service goes up. The only way to avoid it is to put more capital in, right? But then it's the same. It's effectively the same thing, because if you have to put more capital into the deal, then you're going to turn around to the seller and say, well, look, I'm not paying as much, right? So cap rates are going to rise no matter what if interest rates go up, and they already have.
And then it's also fair to say that Class A has the lowest, Class B second, Class C third, right? It kind of goes in tiers. So Class C, higher cap rate than Class A.
So traditionally, now here's something that also happened in the last cycle, which we'll see unwinding in this cycle. So what happened was you typically have, I'd say, about 100 basis points of spread in cap rate between A and B and C, right? So because you have to have a risk premium, right? That's, again, we're talking about, riskier deal needs a higher rate of return. So cap rates are typically higher for the kind of lower down the food chain you get, right? Now, what happened during the boom was that spread got smaller and smaller and smaller to the point where it was effectively no spread at all between A, B, and C. So some smart people said, well, why would I be buying C anymore? I'm just going to go buy A, right? So they went into A properties. Smart thing to do. A lot of other people said, well, look, the C property is trading at a 4 cap, but I'm going to go do a value add and increase the NOI and make my money that way. Now that entailed a whole lot more risk, obviously, because now you've got execution risk, you've got market timing risk, you've got all kinds of stuff. And for a while it went great. It went great until it didn't go great anymore. And that's always the problem with these strategies, is that one day it stops being great. And if you happen to be sitting there, and the typical sort of human nature is like, do 1, it works great, now you do 2. Those go great, now you do 4. Those are great, now you do 8. And then when the music stops, now you've got 20 of these things, and they're all perched at the top, and you did bad debt and all kinds of other things to get these deals done, and now you're really screwed. It's not like you've got one deal that's in trouble and you've got 25 others that are great. Like these new players, this happens every time, right? And so now you're going to see that unwind, right? Did that cap rate compression that happened because interest rates were so low? Well, now that interest rates are high and people are starting to think like, hey, I need more premium for my risk. Well, you just get decompression. So now what you're going to see actually is not just the cap rates will rise, but the lower down the food chain you go, the faster they're going to rise, right? The delta is going to be bigger, right? So maybe the A, like the downtown core, brand new spanking Class A property, like, a block away from Fifth Avenue in New York City. Well, maybe you go from a 4 cap to a 4.5 cap, right? Okay. But like the C deal in some outlying suburb, right, of somewhere, right, that went down to the 4.5 cap. Well, that's probably the cap rate expansion there is going to be back up to like a 7, right? So
or higher, yeah. Because I think what we're going to see in this cycle, again, it typically goes this way. Anytime, it's just called reversion to the mean, right? Yep. If the mean is always 1, 4, 5, 6, and we got down to 4, 4.25, 4.5, you're going to see that C stuff not go to a 6. It's going to have to go to an 8, at least for a time, and then work its way back down. So, yeah, I actually think now, just riffing with this with you, the higher the 10-year note goes in the short term, the closer deals are for me, because I've been very clear. I want to get Class B and Class C stuff in my core markets. So the higher we go from rates, I think the quicker banks realize that it's not going to be clean, and then they're going to make their choices on who to foreclose on and who to force sale. So.
Yeah, but then you really are going to be having to buy out of foreclosure or forced sales
for sure.
Like that. So oftentimes, and then that can actually depress the prices even further, because you go into an auction situation and everybody's like, well, I don't know what I'm buying, right? I don't know, and I've got to come up with cash often to buy it, right? Because I can't get financing for this. So that even further drives down the price. If you're sitting on a bunch of cash, it's great, but
yeah, I've bought directly from banks in the last cycle. 2 of my apartment buildings were directly from commercial banks, local commercial banks. So I look forward to doing that again. Jonathan, you run an amazing school group that's probably going to become very, very popular as deals start to sprout up. Tell us about it.
Yeah, so this is a group that teaches you everything you need to know about multifamily. This is whether you are interested in doing syndication or not. If you're like Michael and you want to buy on your own and you want to understand how to underwrite deals, how to source them, how to do your due diligence, it's extremely helpful what you learn in the course or in the group, I should say. If you want to do syndication and raise money from other people, we talk about that as well. We have 2 calls a month, plus the enormous program you get with all of the materials that you get. So as I've mentioned on the program before, this is going to be going up in price in the new year. So if you want to grandfather in the old price, now's the time to do it.
There you go. Jonathan, you're amazing. Thank you for being here.
Thank you.